Hi, this is Allan Gassman. It's Thursday, December 12, 2019. I'm here in the studio with my friend Barry Flagg, and we're going to talk about indexed universal life. Who says hedge funds are only for the rich? By the way, please join us on Thursday, December 19th, Success Tips for First-Year Lawyers. And of course, more experienced professionals really enjoy going over these basics and a couple of unique ideas you may enjoy. And then I'm going to give part two after Christmas gift, December 26th. David Finkel and I are going to be speaking on 4 steps to grow your business without sacrificing your family health or life on Thursday, January 9th. Please join us for that. And we have a host of other presentations coming up. If you were with us last week, you know that Barry Flagg is a very well-educated, very articulate, very detailed, very ethical advisor. He specializes and actually practices exclusively in the life insurance area. He does a lot of advisory work for lawyers, CPAs, and trust companies to help make sure that we are doing the right thing for our clients and the right thing for our trust beneficiaries in the world of life insurance. Barry, when he became a CFP, was the youngest person to have ever become one. And hopefully he'll be the oldest person to ever be one before we're done here. Barry, welcome.
Actually, I've been beaten. I'm now the oldest, youngest CFP. Someone has beaten me. Some young whippersnapper has now beaten me.
How young was that person?
Well, I was just early 20s, so they must have, of course, when I got my CFP, they didn't have the CFP curriculum offered in college. And there are now a number of universities, including the University of South Florida, I'm proud to say, now offers the CFP curriculum where you can get a degree from USF and be prepared to go sit for the CFP exam and get your CFP at the same time. I did it all self-study, but someone who went through the college curriculum was able to beat me.
Wow. So Barry, before we get started on all these details that you've laid out here in your slides, tell us how, I'm going to go back to the very first slide. Let's say that we're at a cocktail party. It's quiet enough to talk. I'm somebody you know. And I say, Barry, I've got about 5 minutes. What the heck is indexed universal life insurance? And how is it better or worse than the other types of universal life insurance? How do you answer that question?
So I would answer it that indexed universal life is very much like other forms of at least universal life, and really like other what are considered general account products. General account products are whole life and all forms of universal life, products whose cash values are required by regulation to be invested predominantly as a practical matter in high-grade bonds and government-backed mortgages. So universal life and whole life, the assets underlying cash values, even for indexed universal life, the assets underlying cash values are all invested in high-grade bonds and government-backed mortgages, which is important for a reason I'll come back to. So it is similar to other general account products, except so it's the same in most other respects. You know, they all have cost of insurance charges, they all have expenses. Indexed universal life is different in that the interest from the bonds and mortgages, instead of being credited to the account, to the policy account, like in universal life, or through dividends, like in whole life, the interest from the bonds and mortgages can be used to buy options on an index. A common misconception, though, is that too many people think that the account values in an indexed life policy are invested in the index, and that is not the case. As we said a minute ago, the account is invested in high-grade bonds and government-backed mortgages. The interest from that account can be allocated into an index. Is my 5 minutes up?
No, you're doing great.
Okay.
So the typical client thinks that it's invested in something like, for example, the S&P 500, but they think that they're guaranteed that it can't go down in value in any given calendar year, but they understand that if it goes up in value, there may be a cap. So they think that they're S&P 500, but it can't go up by more than 8% in a year.
Yeah,
so
I think. Sorry, go ahead.
So you're saying that they're actually getting a bond, and the interest is buying an option.
Yep.
And the option is expected to provide them with that result.
Correct.
Go down because the bond's not going to go down.
Correct.
And if the S&P 500 does great, then the option is used to buy enough stocks profitably, so to speak, or S&P 500 fund profitably. It's immediately sold and it's immediately turned to the increase.
Correct. Said another way is, you're completely correct that the interest from the bonds and mortgages is used to buy options on the index. If the options expire without value, if the options expire out of the money, is the terminology, then it's valueless, right? You don't lose anything. The S&P 500 could go down. You haven't lost anything other than whatever was used to buy the option. If the option is exercised in the money, then a share of that profit, depending upon how the product's indexing strategy is structured, you either get a participation rate or a participation rate up to a cap, or a participation rate subject to a spread. You get some percentage of that upside. So, if the S&P 500 goes up by 25%, you might get 10% of that. If the S&P 500 goes up by 12%, you still might get 10% of that. But in no cases can you lose. Do you lose investment income in the index product? Although you said something else, they are sometimes promoted as principal protected investment, and while you don't lose the money in the bonds and options or the bonds and mortgages, because bonds and mortgages are stable value assets. While you don't lose the money in the bonds and mortgages, the fees do erode into the value of the bonds and mortgages, or the cash values based on bonds and mortgages. And the fees in index products can be hefty, which is why I make my analogy to hedge funds.
So how big could the fees be?
There are kind of two models or two iterations of indexed universal life. The original iteration worked as we discussed a minute ago, where the interest on from the bonds and mortgages was used to buy options on an index. The newer iterations charge additional fees, and they use those additional fees to buy even more options on the index. And the newest, kind of the top-selling index universal life policies of late have been these policies that, again, in my analogy, they look a little bit like hedge funds. I mean, you always hear kind of the generic description of the fee structure for hedge funds is, 2 and 20. You got to pay 200 basis points, whether the fund goes up or down. You got to pay 200 basis points, which is high. And an S&P 500 indexed fund could be as low as 25 basis points. So 200 basis points is a lot, and a hedge fund typically charges, or often charges, 20% of the upside. And the current iteration of indexed universal life products have the same or a similar, it's not quite as homogeneous, a similar structure where they're charging an assets under management fee or a cash values under in the policy fee that could be 200 basis points. It can actually be more than 200 basis points. Plus, I neglected to say this when you asked me for the elevator description of indexed universal life. When you're buying options on an index, you're buying the option to buy the index. You don't own it. You're buying the option to buy it. And you get to keep the profit on the difference between the price that that you bought the option at and the price of the index at the time you're exercising the option. And the difference between those two is your profit. But because you don't own the index during that option period, you don't get the dividends. Whoever is selling the option owns the index, and they're the ones who get the dividends. And historically, dividends on for instance, on the S&P 500, they've been 20 to 40% of total return. So you're effectively paying 200 basis points, maybe more, plus you're giving up the profit, 20% of the profits, just like you would in a hedge fund. Plus there are insurance costs on top of that. And by the way, I saw in some of the comments to our webinar last week, that I tend to talk about costs. There are a number of studies. In fact, there are studies done periodically that assess the importance of cost to overall performance. And most of the ones that I've seen anyway say that costs are either the most significant determinant or one of the most significant determinants of long-term performance. So I do talk about costs. It's the great unknown in the insurance business. But in talking about costs, I'm not suggesting for a minute that it's not worth it. I mean, there is a hedge fund industry that charges fees that are an order of magnitude higher than the mutual fund industry. And yet it's a thriving industry because you can do things in hedge funds that you can't do in mutual funds. You can't use options in mutual funds. You can't use leverage in mutual funds. So there are reasons to pay higher fees for mutual funds. I just think that because index universal life products are not regulated like a security, there was an amendment to to Dodd-Frank that actually shut down the SEC's regulation of index products as an investment. And so because it's not regulated like an investment, the onerous for figuring out whether or not the cost is worth it and the risk is appropriate, the onus for all of that is on the client and the advisors. There is no regulatory oversight for this like there is for hedge funds.
Okay. So now the life insurance policy will typically have very, very specific and very complicated language defining exactly what the index will be, what the return within the policy will be based upon what the index performance is. Does the life insurance carrier buy an option that does that exactly? Or does the life insurance carrier buy more generalized options and then just apply what they have and receive to meet the policy language?
So there's not a lot in the public domain about the inner workings of these options. There is a guy by the name of Bobby Samuelson that if anybody wants to get as good a glimpse inside the inner workings, not just of the products themselves, but of the strategies. He used to work for a life insurance company. If you ever want to follow somebody who really understands the inner workings of these index products and particularly the indexing strategies, follow Bobby Samuelson. He publishes a newsletter. He does webinars. He would be worth listening to if you really wanted to understand the inner workings. To me, even if you understand the inner workings, I don't know how much good that does you, because there are at least 5 moving parts for indexed universal life policies. So for instance, I said indexed universal life is similar to other types of universal life, in that the cash values are invested in high grade bonds and government-backed mortgages. There's a cost of insurance charge and there's an expense. But that's pretty easy. You look at the expenses, you look at the cost of insurance charges, and what would you expect to get out of high grade bonds and government-backed mortgages? Well, we can look at that. We can look at the track record. 4 or 5%, something in that range. The rate of return that gets credited to the index product is a function of at least 5 factors. The first of which is whatever the carrier says is the participation rate or the cap rate or the spread. Like you said a minute ago, like 100% of the S&P 500 measured point to point, no dividends, up to a cap, like say 10%. But that participation rate and those cap rates, they are not set in stone. They are set for a time by the insurance company, changeable at the sole discretion of the insurance company, and they are a function of the cost of options. Well, in periods of low volatility, where the market just keeps going up and up and up, like we've had for the last decade, volatility is low and the cost of options is low. When we go through periods of high volatility, the price of options goes up. Now, we've not been through index universal life is new enough that we've not yet been through a period of high volatility to know what the impact of the cost of options on indexed universal life participation rate and cap rates will be. But it's a risk that it's going to be something. So what gets credited to the account is a function of the participation rate and the cap rate, which is a function of the cost of the options and what's called the options budget, which is the amount of money the carrier has to buy the options, either from the interest on bonds and mortgages or from these extra costs that they charge the client. And then the fifth part of the derivative, if you will, is how many options are exercised in the money versus how many options expire out of the money. And I've not been able to find any research on that, but I do know that when you're looking at an indexed universal life illustration, the presumption is that half of the options are going to expire out of the money, but the other half are going to be exercised in the money. I've always, in my CFP studies, in my securities, my continuing education requirements for investments in securities, options are not a low risk investment. So a 50-50 probability of making money or not making money sounds high. It sounds like the presumption in the illustration may be overly optimistic. So I'm less interested in what the cap rate or participation rate is at any given point in time. I'm more interested in what determines those participation rates and cap rates, which is the cost of the options budget, and the number of and the frequency of the options being exercised in or expiring out of the money.
Okay. So, Barry, I think you're aware that this product is being sold as a, open quotes, reliable 6% rate of return product, close quotes.
Yep.
What are your thoughts on that?
Well, kind of what we just talked about. The illustrations, actually one of the things we talked about last week, the illustrations might say 6% on them, but the actual rate of return that they've got to get on that product is oftentimes higher than 6%. But even if it was only 6%, the frequency at which the options are exercised in or expire out of the money has a lot to do with whether or not the client, how reliable that rate of return is. In fact, can we go back one slide?
Sure.
So stay right there. So this is the math that illustrates the amount of risk inherent in a given option strategy. Now, I am not an options expert, so I don't know if this is realistic for options trading or not realistic for options trading. If any of your listeners have any insights on this, I am wide open to better understanding this. But just kind of based on my understanding of modern portfolio theory and risk-return trade-offs under modern portfolio theory, if you think about a policy that has $1 million in it, if the interest on bonds and mortgages from the general account, if the interest that the carrier earns that they can use to buy options is 5%, which probably is a little high in today's low interest rate environment, but it's not too far afield from the long-term historical rate of return for high-grade bonds and government-backed mortgages. So let's say the policy has $1 million in it. The carrier's got that $1 million invested mostly in high-grade bonds and government-backed mortgages. The high-grade bonds and government-backed mortgages spin off $50,000. But the policy is illustrating or setting an expected rate of return of 6%. Well, that means the carrier's got to credit. They've only earned 50. They got to credit 60 to the policy. Well, they're going to take that 50 from the interest on bonds and mortgages, and they're going to buy options. To get the 60, they've got to invest the 50, and the options got to be exercised in the money for 60. That's a 20% gain in a year. That seems like a higher risk investment proposition than a more traditional equity investment. In addition to which, that's 20% every year, year in, year out, without exception, because if in any year the options expire out of the money, then the annual return from the index would be 0. And to get back to the 6%, you'd have to earn 40% on the options in the next year. And again, I know options have higher rates of return when they hit than traditional investments or more traditional investments. But that just seems to have a higher risk profile than what the IUL product is traditionally presented as. I am not saying, in the same way I said before, that hedge funds have their place with the right clients in the right situation. I am not saying IUL, Index Universal Life products, are inherently bad. I just think that if you think about what has to happen for that 6% return to come true, there's more risk in an IUL than meets the eye.
Okay. Is what happens inside a universal IUL policy the same thing that happens inside a variable annuity contract that these same carriers issue?
No, a variable annuity or a variable life policy is much more direct. You know, if the market goes up, you participate in that directly, transparently. You know what it is. You can follow, particularly if you're in an index fund, you can follow the index. You can see your account going up by about the same amount. The flip side is if the index goes down below what it was last year, you can lose money, but it's much more direct, much more transparent. On the index universal life products, there's the promise of a benefit that you have this downside protection, potential downside protection. You give up some upside, and you give up the transparency. In terms of cost structure, they both have, cost of insurance charges. They both have expenses. The expenses are going to be different, and the cost of insurance charges could be different. But that's where the similarities end. When you think about performance, The variable products will have much more direct, much more transparent performance, but short-term risk of loss, investment loss. The index products will be less transparent, offer a promise of downside protection, but you're giving up transparency.
Okay. Well, what about the variable? How about the annuity contracts that are indexed? The indexed annuities, are they pretty much the same formula as what's happening inside the cash value of a universal policy?
Same principles. They don't have, now, an indexed annuity doesn't have the same hedge fund characteristics as to my knowledge, as some of these indexed life policies. While the fees could be higher than a true index fund, the participation rates are also lower than you find in generally speaking, in index life policies. But the indexing mechanism is certainly similar between indexed annuities and indexed life products.
Yeah. Okay. So Barry, how do you, now that we've had our 5-minute cocktail talk,
mm-hmm.
and I say
minus
to you,
the cocktail, unfortunately.
Right. So then I say to you, well, what kind of rate of return would I expect with a traditional universal life versus a variable universal life versus an equity index life based on the last 20 years?
So,
your thoughts with your crystal ball?
Yeah, I mean, past performance is no guarantee of future results, but it has proven to be effective for setting the reasonableness of expectations. You know, and I alluded to this earlier, that while an illustration is going to reflect whatever the carrier's current cap or current spread or current participation rate is, it's subject to change, just like anything else. So ultimately, you know, there's study after study that says that the asset allocation is the greatest determinant of long-term of the long-term rate of return that's reasonable to expect. And so I look at a variable life insurance policy, and you know, I look at what's the client's investor temperament. Are they conservative, moderate conservative, moderate aggressive? What's the asset allocation that corresponds to that asset class preference or that risk tolerance? What's the time horizon that we have? Do we have a full market cycle where the volatility historically has worked its way out and the returns migrate to a mean over time? And then what are those expected outcomes? So I look at life insurance no different than I do any other asset. And a friend of mine who teaches this stuff, teaches fiduciary principles in general, came up with this acronym to make it easy for advisor to remember that the rate of return that's reasonable to expect is a function of the RATE or RATE acronym: risk tolerance, asset class preferences, time horizon, and expected outcomes. So you apply that to variable life. If you have an aggressive investor or a client with an aggressive investor temperament, you know, you got a 100% equity allocation, you know, a 10% rate of return. Some say that's overly optimistic on the heels of the financial crisis and this new economic environment that we're in. But historically, a 10% rate of return is not unreasonable. And so I apply that to the different product types, and you see at the bottom, if you have an aggressive investor temperament, then 100% equity allocation would be reasonable. You'd have to do that in a variable life insurance product, and you could get a 9 or 10% rate of return. At the other end of the spectrum, a really conservative asset allocation, would be 20 equities, 80 fixed income. Well, that's like we said earlier that general account products, universal life, whole life, guaranteed universal life, and even indexed universal life, all have to invest cash values, have to invest the assets underlying cash values as a practical matter by regulation in high-grade bonds and government-backed mortgages. And so, the rate of return to expect out of over the long term. I know universal life policies can't illustrate a 5% rate of return right now due to silly regulations more than actual performance. But, I think a universal life or a whole life product, you could expect 5 to 6% over time. So indexed life, you've got to invest the assets in high grade bonds and government-backed mortgages, but you should get some lift over time if you have enough time, back to our RATE acronym, if you have enough time, then those indexes should provide some lift above the above the pure fixed income return. So I think it's reasonable, and this is more intuition than it is actual research. These products just haven't been around long enough. But I think it's reasonable to expect some lift, 6, maybe a little bit more than 6% rate of return. But there's, as we saw on an earlier slide, there's some risk you're not going to get that.
Okay. Barry, are there products that allow the client to decide what portion of the cash value is in this equity index arrangement and what portion would be in I'll call it a money market equivalent fund? So they could basically switch from traditional universal to equity index and back and forth?
Yep. There are just like different variable products have different breadths to their family of funds. Different index products have different breadths to their allocation options. Most of them have some type of fixed account which operates much like a universal life policy, although you are typically, not every time, but typically paying higher fees, either higher cost of insurance charges or higher expenses for the index chassis. So it wouldn't perform exactly like or operate exactly like a universal life because there'd be a bigger drag on the performance of your stable value account or your interest crediting. And then some of them have indexes for S&P 500, European index, the Hang Seng index, a variety of indexes. And then they also have different indexing strategies around different indexes. There could be in the same product, there could be a product that had different participation rates or different caps or different time periods. Instead of a 1-year point-to-point, it could be a 2-year point-to-point or a 9-year point-to-point, which offers the promise of capturing more return because you've got a longer period of time for the market to work its way out, but you also have some greater risk. You're measuring it on one day over 9 years or so, and if it's down on that day, then that's a risk factor. But yes, there are a variety of both universal life investment options and a variety of I shouldn't say a variety of universal life investment options. Most products have a universal life type account in them, along with anywhere from one to various index strategy options.
Okay, very good. Well, Barry, I think I've got a good feel for this. You did a great job explaining it. Is there anything else you'd like to say as our time runs short?
Just that there are. I would not be surprised if there were practitioners on the phone who have found index products to be very useful in their practice, and I do not. I really by talking about a number of things that are just not well understood. I don't mean to suggest that index products are universally not appropriate. They have their place. Again, I think of them a lot like hedge funds. Hedge funds, there's as much money in hedge funds as there is in life insurance. So there is a sizable market of hedge funds. There are places where indexed life insurance products are useful, applicable, but because they don't have the same disclosure requirements and they're not subject to the same regulatory regime as hedge funds, the due diligence responsibility is on the client and the advisor. And so greater attention needs to be paid to the things we talked about today.
Okay, very good. Well, everybody attending, you have Barry's email address down there, bflagg@veralytic.com. Barry also has generously offered anyone who attends this webinar a free Veralytic report specifically on any particular life insurance policy that you might have. You can send that request to info@veralytic.com, or you can email it to Barry, and I'm sure he'll handle it for you.
Yep.
Really appreciate your time today, Barry. Please let us know what you want to talk on next, and we'll be sure to accommodate it.
Always fun, Allan.
Information. Okay, very good. Thanks to everybody. May the rest of your day be billable.
Thanks, Allan.
Thanks again, Barry. Bye.
Bye-bye.